Hey everyone, welcome back to Corporate Decoder, the place where we sift through the corporate jargon, so you don't have to. Today we're diving into a filing from Tevogen Bio, and trust me, it's a roller coaster. This isn't just any filing, it's a post-effective amendment, which sounds like something out of a sci-fi movie, but it just means they're updating a previous registration statement. We're going to decode what this all actually means. Tevogen Bio is updating its registration statement initially filed last year to include their latest annual report. They're not selling any new securities here, just updating what they've already registered. Okay, so what's actually being updated here? This filing is to include information from Tevogen Bio's annual report, their 10K from this year. This prospectus talks about a possible offering of over 42 million shares of common stock. What is this stock for? Well, it can be issued for a few reasons. Warrants being exercised, or if certain future goals are achieved by the company. Here's the kicker. Tevogen themselves admits they might not get a dime from these warrants. Why? Because if their stock price stays below $11.50, no one's going to bother exercising them. Ouch. And since it's trading at around $1, it might not be worth much anytime soon. They aren't exactly budgeting for any cash from the warrants when planning how to spend their funds. Of course, you can expect any SEC filing to have some talk about risks. It's time for the section of the report no one likes, but everyone needs to be aware of. First up, a big red flag, substantial doubt about our ability to continue as a going concern. Translation, they might not have enough money to stay afloat. In simpler words, Tevogen is saying they might run out of cash. This means they might need to borrow more or sell more stock. They have a limited operating history. No approved products, have never generated revenue from product sales, and have a history of significant losses. Their primary source of funding relies on a grant funding that they have not yet received. Development setbacks are a big concern. As a clinical stage company, there are a bunch of things that could happen that might prevent the company from bringing a product to market. Cell therapy regulation is complex. Getting new therapies approved by regulatory bodies is a long and uncertain process. Another warning sign, the management team has limited experience running a public company. This inexperience could lead to mistakes. They might not have enough money to cover their preferred stock obligations, a real possibility that could send the stock price tumbling. Here's a relationship to look out for. CD8 Technology Services LLC is associated with Dr. Manohan Patel, who already owns more than 5% of Tevogen's stock. This type of related party transaction carries inherent risks about conflict of interest. This section talks about risks related to the common stock itself and the warrants. The first item is that the stock price or warrant value might jump around unpredictably. It goes up, it goes down, you never know. That would cause people to lose money. Alright, let's get to some financials and see how the company performed. This is where things get interesting. Time for management's take on how they are doing and what to expect going forward. They admit they expect to continue to have significant expenses and operating losses for the foreseeable future. And to achieve profitability, they need to develop and market products with significant potential. Here's the thing. They have limited experience designing and implementing clinical trials, which is a complex, expensive, and time-consuming process and involves uncertain outcomes. This means we should expect hiccups along the way. The company will need a lot more money in addition to what they already have to achieve their goals. Where will the money come from? No one knows. There it is again, post-effective amendment, meaning changes or updates after the initial registration. The report then gets into the nitty-gritty of the prospectus summary and what it contains. The loan agreement providing for an unsecured line of credit facility, the facility, id pursuant to which the lender agreed to lend the company up to 36.7 million maximum loan amount. It establishes the general terms and conditions under which CD8 would provide the company with access to specialized manufacturing facilities, including clean rooms and laboratories, as well as related operational services, to support the production of their cell therapy products. They have limited manufacturing experience as an organization and with their contractors. All of it creates a challenging situation. All right, let's dig into the meat and potatoes, their table of contents. This always gives us a good overview. Trev, we see risk factors, use of proceeds, management's discussion, and a general business description. These next couple of scrolls are going to be all about numbers. Let's get to the financials for the year. Operating expenses reached $53.5 million, a massive jump, more than 6x from the year before. Most of the increase was in research and development. And for the year 2023, the operating expenses were only around $8 million. It just goes to show you how much more difficult things are getting. There was a very big change in the fair value of convertible promissory notes. a $48 million gain in 2024 as contrasted to a $50 million loss the year prior. Essentially, these types of instruments change value when the underlying stock goes up, so as the stock collapsed. So did that liability. At the end, the net loss was about $13 million. However, the net loss for 2023 was a whopping $60 million. That said, the massive change in fair value of convertible promissory notes has to be seen within the context of the underlying price of the stock. This might imply a similar loss in the opposite direction in the future. The statement of cash flow showed them using almost $12 million in cash from operating activities, indicating high expenses in operations. It seems like their cash is running out fast, from 5 price 4M to $1 3M in a span of 2 years, despite drawing some funding on its credit lines. The question is what is going to happen in the future, and can they stay afloat long enough to actually create some value? We learn what it will cost to keep going. It depends on so many factors, including the costs involved in getting the regulatory agency's approval, whether they're going to partner with other companies, and the costs and timing of actually selling future products. This just keeps repeating that they may not have the funds necessary to satisfy future obligations under the terms of the preferred stock and the convertible debt. If they can't handle this, it could make it harder for them to get more money later and make the stock more volatile. They might issue additional shares which would dilute ownership and cause the stock to be worth less. This is always something to worry about in a company. Dr. Sardi has more than half of the company's voting power. He gets to decide almost everything. They might take the warrants away from warrant holders at a time that the warrant holders wouldn't like, and that might make the warrant worthless. This brings us to the end of the document analysis. We've gone through it all. Let's analyze if Tevogen Bio presents a high risk, high reward scenario. Their technology is interesting and they have a leadership that is knowledgeable. However, their cash position is a big concern, and their ability to execute their plans depends on factors beyond their control, such as the FDA fall. Overall, Tevogen Bio feels like a long shot to invest in unless they can obtain partnerships, which is something they mentioned in the report. What do you think about Tevogen Bio? Let me know in the comments below. Don't forget to like and subscribe. Thanks.